Welcome to the Daily Brief, where I'll go over the action in the market for Tuesday, February 28th, and then we'll see how things look for Wednesday, March 1st. We had a pretty sleepy day. The S&P ended up being down on the day. It still kept the short-term look at being negative, and even in the intermediate term for right now, we're not really working off this short to intermediate term oversold condition, and a lot of that still persists, which could give us some support to go up from here. But overall, our technicals remain negative, and we're still in a pretty decided downtrend. So let's go back and talk about what happened. Right at the open, we had a lower open, not really much of a gap. And then right after that, prices just went sideways. As the day went on, we were able to get back above the unchanged level. We were able to get above the daily pivot at 39.91, and then we stalled at just under the 4,000 level. Prices then started to go back down. We went below the daily pivot, below the unchanged level, and we ended up closing at the low. We were down 0.30% on above average volume. We haven't seen that in a while. So our technicals are still negative overall, especially in the short and intermediate term. The markets are continuing to be fixated on this idea of inflation and interest rates. What's that going to do to earnings per share? What's that going to do to our valuation concerns? We're coming up towards the end of earnings season, and nothing that I've seen really has yet to do with handling the debt ceiling situation. Here's the intraday chart, where we did have a lower open below this dash line, which is the unchanged level. Just chopped sideways for quite a while. Tried to break out, came back down, tried to break out and go positive again. We went above the daily pivot, which is this dark blue line, chopped sideways. When no more buyers started coming in, we fell back below the daily pivot, down below the unchanged level, ended up dropping going into the close, and closed pretty much at the low for the session. So what are some comments that we can make? The S&P, it's still above its 200-day simple moving average, but with Tuesday's action, we dropped below the 50-period simple moving average. On a short-term basis, the stochastics, the Stochh RSI, and the Williams percent R continue to be extreme negative. On an intermediate-term basis, we have the McClellan Oscillator, the PMO study, and the CCI 20 are also extreme negative. The dollar was up slightly and interest rates were down. We still have all of our yield curves that remain inverted. We're watching to see if they kick back over and are no longer inverted, but we're still a long way from that happening. Sentiment remains positive at 59, where we ticked down slightly from 61. Our trend is still positive. The green line is just barely above the red line, but it's weakening because we're below 20 with the ADX. I've kept our bias and momentum at mixed because we're not really seeing any conviction one way or the other right now. The market is negative, but we're extended to the downside. We saw a bounce attempt on Monday, but we didn't see any follow through on Tuesday. As far as the economic reports that came out, we had the Advanced International Trade in Goods that came in at minus $91.5 billion, a little bit more than the minus $89.7 billion last time. The retail inventories were at 0.3%. Last time they were up 0.4%. Wholesale inventories were down 0.4%, or last time they were up 0.1%. These advanced readings, they're good on an economic basis, but they don't really have much of an influence on what the stock market does. The FHFA Housing Pricing Index, it came down 0.1%. Last time it was also down 0.1%. The S&P Case-Shiller Home Price Index, it came in at 4.6%, where they expected it to come in at 5.8%. So that was weaker than expected. And last time it came in at 6.8%. The Chicago PMI came in at 43.6. They expected it to come in at 45. So that was weaker than expected and below 50. So it's showing contraction in the economy. The last time we had this report, it came in at 44.3. Consumer confidence also came in weaker than expected at 102.9. They expected it to come in at 108.4. Last time it came in at 106. Looking at some of our charts, the Ulcer Index continues to be above the moving average. It ticked down slightly even on a down day. It's showing an overall increase in fear. The VIX ticked down on a down day, kind of strange, showing that complacency is still rather high. We're above 20, but not very far above 20. If we see some real downward movement, we will generally see the VIX really start to spike up, and it's just not doing that, at least yet. And then the bar chart down at the bottom, we're starting to drop below the moving averages, showing a little bit more complacency even on a down day. The VIX of the VIX is also starting to come back down, so volatility is continuing to shrink. We had the latest reading of the American Association of Individual Investors. Because we had the negative week last week, they reacted to that, and so they had been above the zero line. Well, we've dropped down below the zero line to minus 17, and not an extreme reading yet. The trend is showing where the green line is just barely above the red line. They're both going down, so this is really showing a lack of conviction. The black line is the ADX, and it continues to decline and is below the moving average. Because the green line is just barely on top, we default to the positive side, but that could change one way or the other depending on if we have an up day or a down day in Wednesday's session. But right now, we're overall in a trendless environment. The daily chart showing how we dropped down below this pivot level. We're still holding up above the 200-day moving average, but we came slightly down below the blue line, which is the 50-period moving average. Another thing to notice on this chart is we're now below this upward sloping trend line. And then on the bottom, you can see where volume did pick up and go above average. The first time in a while since we've seen that. The stochastics in the short term remain extreme negative, intermediate term extreme negative, and declining in the long short term. And remember, this chart is a subdivision of the short term overall. The Stochh RSI and the Williams %R still are extreme negative. The Arun indicator, haven't shown this in a while, but we finally saw some movement in this where sellers really picked up and buyers are decreasing. So it dropped the oscillator from being positive down now to being negative. This is the 50-period moving average where we closed just slightly below the red line, which is the 50-period simple moving average. Here's the 100-day moving average study. We're just a little bit below the exponential moving average. The Chaikin oscillator continues to decline and has now dropped below this dashed line, and that is more negative. The CCI 20 remains extreme negative. In our PMO study, we're still extreme negative with the percent of PMOs that are rising at extreme negative. Also, the buy signals are getting extreme negative, and we continue to decline with the PMOs that are above zero. This is a little bit positive. The Swinland trading oscillator based on price and volume did turn back up, and sometimes this can be a leading indicator for us. We don't always know at the time if it will be or not. We just want to be aware of that to see if it's confirmed by follow-through price action. The BPI's ticked a little bit down below 50 now, so that's more negative. After giving us this extreme positive reading, it's been coming back down, and this helps to show us what is the internal strength or weakness of the S&P. Another chart that we look at is the NYSE bullish percent index. After breaking out, it's been coming back down. We were chopping sideways from Monday to Tuesday, but it is showing some continued weakness after looking like it was giving us some real strength. The Chaikin money flow continues to decline even though it is positive with the green bars. The balance of power continues to be below the dashed line and declining. That's negative. The TTM squeeze continues to add to the red bars. That's negative. And we've switched to an official no-go system, which is like a sell for this particular trading system. Where we had been neutral overall, we switched to the brown bars. Well, now it's switched over to purple, and that's more negative. Looking at our short-term fib levels, we still have this 4,700 level above current prices. If we continue to drop, we're going all the way down to 3908, according to this chart, before we find some short-term fib support. Looking at a longer-term fib chart, we're still below this 3998 or 3999, which you could round up to 4,000. We're below this level currently, and we're still in no man's land with our long-term fib chart. We have some resistance at the 4020 level if we continue to go back up. If we fall drastically, we're looking at 3826, but currently we're in no man's land. Looking at our moving average tree, this is just a breakdown more of the moving averages that I showed you, where we're below the 50 and the 100 is starting to give some support. When we're dancing around in here, this can be a real mess. That's why I break out some of the moving averages to show you. The Elder Impulse system for the S&P 500 remains neutral, and the McClellan oscillator is still extreme negative. And looking at a broader measure of the McClellan oscillator, after coming down and bouncing back up, it is showing a little bit of strength. We saw some across-the-board strength in the stock market that didn't really reflect itself in the S&P 500. So that's a little bit of a positive divergence. The summation index based on price and volume continued to decline, and we've dropped below the zero line with the volume indicator. New highs, new lows, not really seeing much of anything, so we're dropping off with the 5 period and we're flat to slightly declining with the 10 period. We're still above the moving average with the advanced decline line based on price and volume, but it is showing some weakness. The advanced decline ratio continues to be below 0. That's negative. Accumulation distribution, after really holding up the last few days, it's now dropping below the moving average. So this is turning more negative. We saw the pickup in volume a little bit. We're still below average overall, but we did see an increase. The pring bottom fisher is starting to roll over. Once these two cross, that buy signal will now be history. The diamonds are continuing to be negative with the elder impulse system. The NASDAQ 100 is still maintaining itself above the 200-day moving average, and the elder impulse system for the NASDAQ 100 continues to be neutral. Here's a new chart that I haven't shown before. This is the elder impulse system for the small caps, and they continue to be neutral. Here's the small cap to S&P 500 ratio, which this is still holding up fairly well. This could give some support to the market. We're in an overall uptrend with this ratio, and we're breaking out a little bit. That means that small caps are outperforming the S&P, and a lot of times that will really give some support to the S&P 500. Here's another new chart, the mid caps using the elder impulse system, where we also continue to be neutral. An update of our possible positive scenarios. We're still holding up fairly well with the QQQ to SPY ratio. We're above an advancing moving average. With the discretionary against the SPY, we're also holding out above a moving average. Large cap growth to large cap value is also above an advancing moving average. Looking at the growth to value ratio for the large caps, still holding up. Mid caps holding up, not holding up with the small caps. We're starting to go up with the 2-year yield, and so we are probably taking out this spike. We'll want to see once it stops and starts to go back down. Sometimes that can give some support to the S&P, but it hasn't happened yet. The staples to S&P 500 ratio, still looking viable. We're still working off of this spike here, even though we've been declining and coming back up. It did decline a little bit in Tuesday's session. So what's our outlook for Wednesday? The technicals are negative, but we're still short-term oversold and somewhat intermediate term. We have the weekly MBA mortgage index coming out, the final reading of the IHS Market Manufacturing Purchasing Managers Index, or PMI, construction spending, and then the big one will be the ISM Manufacturing Index. All the list of geopolitical events with the markets really fixated on the inflation and interest rate scenario, but any one of these could come to the forefront at any time. We don't have any speeches coming up on Wednesday, but we do on Thursday as well as on Friday. Looking at the Stock Traders Almanac statistics, I tried to go through and update some of this. For the S&P 500, we tend to see more mid-month strength. So as we get into the middle of the month, but then some late month weakness as we're getting ready to end the quarter. Looking back over the last number of times, we've been up 13 out of 21 times. That's 61.9% with an average gain of 1.1%. So a slight bias towards the positive side for the month of March. March also sees a lot of fluctuations with either large gains or losses. The average return, as I stated before, is 1.1%, but during a pre-election year, which is what we're in right now, the return is 1.9% on average. During options expiration week, we still have a few weeks before that, we're up 65.1% of the time and down 34.8% of the time. Then the week after expiration, we're up 34.8% of the time, so things turn much more negative, where we're down 65.1% of the time. Looking at March 1st, where the Dow, the S&P, and the NASDAQ, we have a pretty positive seasonality. Now, some of this has to do with the very first trading day of the month. There's usually a lot of inflow of cash. But the Dow's up 61.9% of the time. That's positive. The S&P's up 71.4% of the time, which is also positive. And the NASDAQ's up 66.7% of the time, which continues to be positive. Over the last 73 years, March has generally been up 64.4% of the time, where it's declined 35.6% of the time. Then the yearly basis, this is not changed from what I was showing before. We're still working off that 3-0 trifecta with the Santa Claus rally, the first 5 trading days, and then since January was up, that's given us a score of 3-0. And when all 3 indicators were positive, over the next 11 months, we've been up 87.1% of the time, with an average gain of 12.3%. When you take the full year, all 12 months, we're up 90.3% of the time with an average gain of 17.5%. The markets also like that we're split between Democrat and Republican within the different branches of our government. Here's a chart of March showing how we tend to start off, especially in a pre-election year. The green dash line is the S&P 500. For the first trading day, the second trading day, and the third trading day, we tend to be up overall. We're also going to have non-farm payrolls coming out on Friday, which is the third trading day. But then after that, we see some pretty solid weakness before things attempt to bounce. Then in about the middle of the month, we start to see things improve, only to show a little bit more weakness going into the end of the month. These numbers on the bottom are the trading day number. So number 1 is the first trading day. Number 5 is the 5th trading day. They don't line up with the dates. Also, a chart that I've been showing for a little while is how does the S&P tend to perform historically. This boxed area is where we're at right now. And looking at the green line, which is a pre-election after a midterm bear, which is what we had, we tend to see a pretty good return. Not that we're going to go straight up, but overall it tends to be more positive. Also, we're coming into a time now where it's called the sweet spot, where if we're going to see some good advances, we would likely see them about now based on history. Doesn't mean that this is going to happen. It's just historically this is what has happened. And during this sweet spot, the S&P has a return of 20%. So our scenarios, can't really go with the down one right now because we're short-term oversold and we're not trending. Definitely can't go with the up one because our technicals are negative, but we may get some kind of a bounce since we are oversold. So we're going with the sideways trend because the ADX is below 20. It is weakening below the moving average and it's just barely positive. So if we see a bit of a down day, we could easily switch back to a negative bias. The conclusion, the S&P is negative, but it's short-term oversold. In the short term, negative, still mostly oversold. Intermediate term, a little bit oversold. Long term, we're still above the 200-day simple moving average, so we remain more positive, and we're still working off of that recent golden cross. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.